In this video, I will be discussing different default risk models. Economists, analysts, and financial institutions managers have applied different models to assess the default risk or the credit risk on loans. These models vary from relatively qualitative to highly quantitative model. And these models also not mutually exclusive in that a financial institution manager may use more than one model to reach a credit pricing or loan quantity rationing decision. As far as the qualitative models are concerned, in the absence of the publicly available information on quality of borrowers, the financial institution's manager has to assemble information from private sources. For example, credit or deposit files and or purchase information from external sources, for example, credit rating agencies. This information helps a manager make an informed judgment on the probability of default of a borrower and price the loan, set the interest rate correctly. In general, the amount of information assembled varies with the size of the potential debt exposure and the cost of collection. However, a number of key factors enter into the credit decisions. These include borrower-specific and the market-specific. So borrower-specific factors are the idiosyncratic to the individual borrower. That means those are specific to a particular borrower, and market-specific factors are the factors that in general affect all the borrowers in a particular time period. Borrower-specific factors typically are reputation, leverage, volatility of earnings, and collateral. Let me very briefly describe each of them. The borrower's reputation involves the borrowing lending history of the credit applicant. If over the time, borrower has established a reputation of prompt and timely repayment, this enhances the applicant's attractiveness to a financial institution. A long-term customer relationship between a borrower and lender forms an implicit contract regarding borrowing and repayment that extends beyond the formal, explicit legal contract on which borrower-lender relationship are based. With regard to the leverage, a borrower's leverage or capital structure, which is typically measured as a ratio of debt to equity, affects the probability of its default. This is the case because large amount of debt such as bonds and loans increase the borrower's interest charges, pose a significant claim on its cash flows. Volatility of earnings, actually with the leverage, a high volatile earning stream increases the probability that the borrower will be unable to meet fixed interest and principal charges for any given capital structure. Consequently, newer firms or firms with high-tech industries with a high earnings variance over time are less attractive credit risk than those with long and more stable earnings histories. And last of all, a key feature in any lending and loan pricing decision is the degree of collateral or assets backing the security of the loan. Many loans and bonds are backed by specific assets should a borrower default on repayment obligation. Mortgage bonds give the borrower first claim to some specific piece of property of the borrower, normally machinery or building. Debentures give the bondholder a more general or more risky claim to the borrower's assets. Market-specific factors, those in general affect all the applicants in a particular time period, is the business cycle and level of interest rate. The position of the economy in the business cycle phase is enormously important to a financial institution in assessing the probability of borrower default. For example, during recessions, firms in the consumer durable goods sector that produce cars, refrigerators, or houses do badly compared to those in the non-durable goods sector producing tobacco and food. High interest rate level indicate restrictive monetary policy actions by the Reserve Bank of Australia. So financial institutions not only find funds to finance their lending decisions scarcer and more expensive, but also must recognize that high interest rates are correlated with high credit risk. So you can see the position of the business cycle and the level of interest rate can be important inputs in the qualitative model of default risk. Now, the quantitative models, you can see, use observed borrower characteristics to calculate credit scores. That's why they are typically known as credit scoring models. So credit scoring models use different characteristics of the loan applicant to calculate a score representing the applicant's probability of default. Or by doing so, the models sort borrowers into different default risk classes. By selecting and combining different economic and financial borrower characteristics, the financial institution may be able to numerically establish which factors are important in explaining default risk, evaluate the relative degree or importance of these factors, improve the pricing of default risk, be better able to screen out bad loan applicants, and be in a better position to calculate end results needed to meet the expected future loan losses. The primary benefit from credit scoring is that the credit lenders can more accurately predict a borrower's performance without having to use more resources. To employ credit scoring models in this manner, the manager must identify objective economic and financial measures of risk for any particular class of borrowers. For consumer debt, the objective characteristic in a credit scoring model might include income, assets, age, occupation, and location. For commercial debt, cash flow information and financial ratios such as debt to equity ratio usually the key factors. So three major credit scoring models that we will be discussing here are the linear probability model, logic model, and linear discriminant model. First of all is the linear probability model. This model uses past data, such as financial ratios, as inputs into a model to explain repayment experience on all loans. The relative importance of the factors used in explaining past repayment performance is then used to forecast repayment probabilities on new loans. That is, factors explaining past repayment performance can be used for assessing the probability of repayment. Now, briefly, let's divide all loans into two observational groups: those defaulted, so probability of default equals to 1, and those did not default, so probability of default equals to 0. Then we relate these observations by linear regression. I think you are familiar with linear regression model. Linear regression to a set of causal variables that we believe causes a particular loan to be defaulted or not defaulted. Okay, for example, leverage, earnings, and so on. So, and we estimate a linear regression model like this, where the dependent variable is the probability of default, and these x variables are the explanatory variables that determines that whether a loan defaulted or not defaulted. So these betas are essentially the parameters, estimated parameters of the variables that are explaining past repayment experience. Now, once we estimate this model based on the past data and we get the parameters, estimated parameters, then these estimated parameters are used to estimate the probability of default of a current loan. Okay, so this is how we use the linear probability model. Now, one point, while the linear probability model that we discussed in the last slide is straightforward, as long as the current information on the explanatory variables is available for the borrower, it has a major weakness that the estimated probability of default can often lie outside the interval of 0 to 1. That means in this model, as I said, that we get these estimated parameters, we multiply them with the values of these ratios for a particular borrower, and we sum them up to get a probability of default, which can lie even in exceeding 1. But you know that statistically or economically, the probability should lie between 0 to 1. But in this linear probability model, the probability of default can exceed that that range of 0 to 1, which is statistically or economically meaningless. The logic model overcomes this weakness by restricting the estimated range of default probabilities to lie between 0 and 1. So essentially, this is done by plugging an estimated value of probability of default. That means we get a probability of default from the linear model. We put it in a formula. We are not showing it here. You have this formula available in the textbook. So we put it in the formula to restate the probabilities so that the probability of default lies between 0 and 1, and it becomes statistically and economically meaningful. Now, linear discriminant model. While linear probability model and logic models that we discuss project a value for the expected probability of default if a loan is made, discriminant models divide borrowers into high or low default risk classes contingent on their observed characteristics. Similar to linear probability models, linear discriminant model use past data as inputs into a model to explain repayment experience on all loans. The relative importance of the factor used in explaining past repayment performance then forecast whether the loan falls into a high or low default risk class. Consider a discriminant analysis model developed by Professor Altman for publicly traded manufacturing firm in the United States. The indicator variable Z, you can see it here, is an overall measure of the default risk classification of a commercial borrower. This in turn depends on the values of various financial ratios of the borrower X and the weighted importance of these ratios based on the past observed experience of defaulting versus non-defaulting borrowers derived from the discriminant analysis model, which can be seen here. So this is essentially the Altman's discriminant function, where we see that the default probability of a fund based on 5 variables. Okay, X1, X2 up to X5. X1 is working capital to total asset. X2 is retained earnings to total asset. EBIT is, X3 is EBIT to total asset. X4 is market value of equity to book value of long-term debt, and sales to total asset. So for the US manufacturing firm, this model was estimated and the estimated parameters are already there. Now, if we have a credit applicant, what we will simply do is we will take these ratios, we will take all these 5 ratios, and each ratio will be multiplied by their corresponding estimated parameters to finally get the value of a Z. So that will indicate the probability of default. So the critical values for this Z value is 1.81 to 2.99. If the Z score of an applicant is less than 1.81, then it will be indicated as a high default risk borrower, and if Z score is greater than 2.99, will be indicated as low default risk borrower. However, there are a number of problems in using the discriminant analysis that we just discussed in the last model. It is worth noting that most of these criticisms also apply to linear probability model and the logic model that we discussed earlier. The first problem is that these models usually discriminate only between 2 extreme cases of borrower behavior: default or no default, high risk default or low risk default. So as introduced previously, in the real world, various gradations of default risk exist for non-payment or delay of interest payment to outright default on all promised interest and principal payment. This problem suggests that a more accurate or finely calibrated sorting among borrowers may require defining more classes in the discriminant analysis rather than just having 2 groups of default or no default or low risk or high risk borrower. The second problem is that there is no obvious economic reason to expect that the weights in the discriminant function, or more generally the weights in any credit scoring model, will be constant over any but a very short period of time. You can remember in the linear discriminant model, these are the weights, or these are the parameters we are using, and in the linear model we estimate these parameters, and these estimated parameters are used to calculate the probability of default. However, you know that these parameters are estimated based on historical data, and these parameters unlikely the weights are unlikely to remain the same in future. The third problem is that these models ignore important, hard to quantify factors that may play a crucial role in the default or no default decision. For example, the reputation of the borrower and the nature of long-term borrower-lender relationship could be important borrower-specific characteristics, as could macroeconomic factors such as the phase of business cycle. So you can see that we have the certain ratios that we use as the inputs in the model. However, these models might these ratios might vary over time, and sometimes some hard to quantify variables may have important role in determining whether a loan should be placed in a default or no default class. To avoid this problem, newer credit risk model use financial theory and more widely available financial market data to make inferences about default probabilities on debt and loan instrument. Consequently, these models are most relevant in evaluating loans to larger borrowers in the corporate sector. So there are a few, but we will discuss only one here today, is RAROC, which is the risk-adjusted return on capital. Risk-adjusted return, or RAROC, the model was pioneered by Bankers Trust and has now been adopted by virtually all the large banks, although with some significant proprietary differences between them. The essential idea behind the RAROC is that rather than evaluating the actual or contractually promised annual return on asset on a loan, that is net interest or fees divided by amount lent, the lending officer balances expected interest and fee income against the loan's expected risk. So you can see that RAROC is calculated as 1 year net income on a loan. So typically what we do is, when we calculate rate of return on a loan, we use the interest income or expected interest income on a loan. Now you understand that this interest income might vary based on the risk. So what we do is we take the risk adjusted income and also the capital at risk. So rather than dividing the annual loan income by asset lend, it is divided by some measure of asset risk, or what is often called capital at risk. So once we calculate this RAROC, a loan is approved if RAROC is sufficiently high related to the benchmark return on capital, ROE, for the financial institution, where ROE measures the return shareholders require on their equity investment in financial institutions. So the numerator, which is 1 year net income on a loan, is essentially the spread of the interest plus fees multiplied by the dollar value of loan outstanding. And this actually RAROC model can be used to find out the change in credit risk premium that can be estimated from the publicly available data. So you can see that this delta RI minus RG is the change in yield spread between the corporate bonds of credit rating class and the match duration treasury bonds over the last year. So that indicates how much credit risk changes. And last of all, you can see that ROAROC is the 1 year income per dollar loaned divided by unexpected default rate multiplied by the proportion of loan loss on default. So these information are easily available. As a result, RAROC can be easily calculated and can be compared with the benchmark return to decide that whether a loan should be approved or rejected. So this is the end of this chapter. So essentially in this chapter, we have learned about the problem with the credit quality, different types of loan, and different default risk models. Thank you very much.